Hi folks, welcome to today's Bobcast. I'm Bob Binney.
I'm Jesse Thompson.
And today's topic of our Bobcast is sneaky retirement risks to prepare for. Sneaky.
You look sneaky when you said that.
Yeah, well that's what I mean. Sneaky retirement risks to prepare for.
Watch out for
We're gonna go through these kind of quick. So the first sneaky retirement risk is the market or sequence of returns.
Yeah, this is the one that I think everybody thinks of first when they think of what they're worried about as far as investing in retirement.
Right.
And sequence of return risks, that basically, what that is that you're going to hit a bear market at the wrong time in retirement, particularly right when you retire. That can be more dangerous than hitting a bear market or a bad time in the market when you're later on in retirement and your retirement accounts have had a chance to grow more. If you hit it right at the beginning, that's the worst.
Yeah, so it's the idea of, you're starting to take money out of your account and, you have a market downturn of 20% or something like that. Then if you're taking 5% out, it even devastated your account even more. So that's a risk that people need to, but they're already looking at that risk. And we have different kinds of strategies that we use and other financial guys use to try to mitigate that risk. Not that we're going to talk all about that right now.
Yeah, we're going to do that actually in the next video. We're going to talk about what you can do about
so
these
stay
risks.
tuned. Stay tuned. So the second, and I think probably the most important retirement risk that people don't pay attention to or don't think about.
This is the number one sneakiest.
The sneakiest risk is not taking into account inflation. And particularly now when we're in an extremely high inflationary environment because all the money the government printed, they increased the money supply by 40% over the last 3.5 or 4 years. And so that's going to cause, double-digit inflation for a while, whether the government admits to it or not. That's what it is. Anybody that buys stuff knows that's what it is. Well, when you're having inflation rates, the cost of living of stuff you're buying is going up by 10-15% a year. You need to have in your retirement money or investments that will grow at that rate or greater in order to keep from going in the hole. Back when I first started being in the investment business in the early 90s, I went through a retirement neighborhood. Everybody in there had to be 55. And when I met the older folks, the people that were in their mid-80s, seems like they went into two categories. One category, people had put their money in CDs and something super duper safe.
Safe, fixed.
Yeah, safe, fixed loan type investment for what a CD is. And the other category, people put some or most of their money in stock market type investments like mutual funds or individual stocks. And the people that put their money in fixed income investments, they were scraping along in their mid 80s because their cost of living had gone up at a higher rate than their money had gone. And so they were worried about the next Social Security increase or whatnot. The people that had invested in companies had that, which is a great hedge against inflation. Now they're worried. They got worries too. Their worries is how do they transfer this money to their kids without the government getting so much of it. They're worried about the size of their estate. I'd rather be worried about that than worried about what the next Social Security increase is going to be. So inflation is the number two sneaky, maybe the sneakiest retirement risk.
Mm-hmm. The number 3 risk is interest rate risk. And this has to do with bonds. So the way that the value of a bond works, it's a mathematical equation. When interest rates go up, bond values go down. So if you own a bond at a certain interest rate and the overall interest rate where people can buy new bonds and get a higher interest rate on their bonds, get paid more money for their bonds, your bond, say you have a bond at 4% and these new bonds are coming out and they're at 6%, the value of your 4% bond, nobody's going to want to buy it. The value of it is going to go down a lot. And so if you sell it it's going to be valued at a much lower price.
Exactly. So I look at it like a teeter-totter. The interest rates and bond market values are negatively correlated to each other. And so the key thing about that for right now, because we think that interest rates are going to keep going up until inflation gets under control. I know you hear different things on the news media, but pretty much the only real tool that the government has to try to fight back inflation is to raise interest rates. And so if you think that interest rates are going to go up, it's an automatic that the bond prices are going to go down. So if you think interest rates are going up, you shouldn't be buying bonds now. So,
and that's a sneaky risk in retirement, because a lot of retirees think that they need to have more bonds in their portfolio.
Yeah, they think they're safe
because
by
they've
bonds.
been traditionally told that you need to have more bonds in your portfolio after you retire.
So the number 4 sneaky risk is not having an estate plan, because a lot of times people aren't thinking about having an estate plan until they somehow have this mental attitude that if I don't have an estate plan, I won't die, that creating an estate plan is going to cause my death. Well, that's not true. But I guarantee you some people are going to die today with an estate plan, and some people are going to die today without an estate plan. And the beneficiaries of those people that pass away today or this month or this year, whatever, with an estate plan, the correct kind of estate plan, are going to be way happier than the ones where they left a mess for their beneficiaries.
And a good estate plan also protects you in your retirement while you're alive too, because you're going to have a power of attorney for assets that's included in the estate plan. You're going to have somebody who can act on your behalf if you become incapacitated or need help in a legal capacity on your behalf that has your best interest in mind. So it also protects you while you're living in your retirement.
So the final thing that we call a sneaky risk in retirement is not spending enough.
Being too conservative with your retirement income plan because you're afraid of running out of money.
And the thing is that you have to keep in mind that we help people think about is you're going to be way more interested and energetic and willing to do fun stuff early in your retirement than later, than maybe your mid-80s. And I'm not talking about not spending enough, meaning you should go out and buy new cars and new houses and a lot of stuff and things like that. but we run across more people that are, at least of our clients, that are maybe being a little bit too conservative early in their retirement.
And it's partially because they've built their wealth by being like that.
Yeah, but we try to encourage them based on good financial principles and the different tools that we use in our experience. We try to convince them or encourage them to use some of that money that they saved, because in reality, if they don't use it, it's just going to keep growing and keep growing and keep growing, and then they're going to die and leave it to their kids, and their kids are going to use it. I encouraged my dad, your grandpa, I guess it was about 25 years ago. He was early in his retirement. He was thinking about buying a boat, but he was kind of worried about whether he should buy a boat or not. And I remember telling Dad, I said, Dad, you need to go ahead and buy a boat, because that money's going to buy a boat. It's either you're going to buy the boat or my brother Rick's going to buy the boat with his share of the inheritance when you pass away. So you might as well buy a boat now. And so he did, and had some fun with that boat, and we've all got to use that boat.
So those are some 5 sneaky retirement risks to prepare for. Next week's Bobcast, we'll talk about how to logically prepare for each one of those things. So stay tuned. Thank you for joining us today. Make sure you like and subscribe if you haven't, and we hope you have a great rest of your week.